Welcome to the deep dive. Today, we're going to be taking a look at the stock market. You've been wanting to understand this better, right?
Right.
You sent over some excerpts from the podcast, Stock Market Basics, Unlocking Wealth, One Trade at a Time, specifically episode 1. So I think that's where we'll be focusing our deep dive today.
Excellent choice. Episode 1 of that podcast is really good. It lays a solid groundwork for understanding, how the stock market works and its potential.
Okay, so let's unpack this. The podcast uses this interesting analogy. It compares the stock market to a supermarket for ownership. What do you make of that?
That's a great way to visualize it. Instead of picking out groceries, you're selecting pieces of different companies. To own, that is.
Ah, okay.
Those pieces are called shares. And when you buy them, you become a shareholder.
So it's not like investing in some abstract idea. You're actually buying into a real business.
Precisely. And these businesses, well, to raise money for expansion, they list their shares on exchanges, like the Bombay Stock Exchange and the National Stock Exchange here in India.
Right.
This allows investors like you to participate in their growth.
Yeah.
And potentially profit from it as well.
Okay. And so here's where it gets really interesting. The podcast then compares the stock market to an auction house. How does that work? In practice, I mean.
Imagine a bustling marketplace where the price of an item is constantly changing based on, how many people want to buy or sell it. That's essentially the stock market. If a company releases a promising new product or reports strong earnings, then investor confidence goes up, demand for the stock increases, and the price goes up.
But if something negative happens,
Yes,
like poor financial results.
the opposite occurs. People lose confidence, they sell their shares, and the price goes down.
It's a constant dance between supply and demand.
Exactly.
Influenced by all these factors, from company performance to overall economic conditions.
Yeah.
The podcast uses a great example to illustrate this. Apple and the launch of the iPhone. It really drives home the potential of long-term investing. Imagine you had bought Apple stock when that first iPhone came out.
Yeah, at that time, it was a revolutionary product, but few could have predicted how dominant it would become. Those who invested early and held on to their shares would have seen their value increase dramatically over the years.
Dramatically, yeah.
Dramatically.
It's a powerful example of how investing in a company with strong growth potential can lead to significant returns over time. But it also raises a bigger question. Why should someone invest in the stock market? What makes it so compelling?
Well, there's several reasons. And the podcast highlights 4 key benefits. First, historically, stock markets have outperformed other investment options, like fixed deposits or savings accounts. You see, offering the potential for greater wealth creation over time.
That makes sense. Stocks have a higher potential for growth, though, of course, they also come with inherent risk. It's that classic risk-reward trade-off.
Exactly. The second benefit is the potential to outpace inflation. We all know that inflation erodes the purchasing power of our money over time.
So if your money's just sitting in a savings account, it's actually losing value each year.
Right. But stocks, especially those of companies that are growing and increasing in value, can offer returns that exceed the rate of inflation, helping you preserve your purchasing power.
Okay. It's like a shield against the silent thief of inflation. So what's the third benefit the podcast discusses?
The third one is passive income, specifically through dividends. When companies make a profit, they sometimes choose to share a portion of those profits with their shareholders. Those payments are called dividends.
So as a shareholder, you're essentially getting paid just for holding on to the stock. That's a nice perk, especially if you're invested in companies with a solid track record of dividend payouts.
And that leads us to the fourth benefit, which is often overlooked, ownership and influence. When you buy stock in a company, you become a part owner, even if it's a tiny fraction, and that comes with voting rights.
So even if I'm not a major investor, I still have a say in major company decisions. That's pretty powerful.
You do. It's a reminder that investing in the stock market isn't just about numbers and potential profits. It's about participating in the growth and direction of companies you believe in.
We've covered a lot of ground, but I know there are some common misconceptions about the stock market, like things that hold people back,
Yeah.
The podcast addresses a few of these. So let's dive into myth-busting territory.
Absolutely. The first myth we often encounter is that investing in the stock market is just like gambling, that it's all, luck and chance, no real skill involved.
It's easy to see why people might think that, especially with all this talk of market volatility and unpredictable swings.
But That's a dangerous oversimplification. Informed investing is based on research and analysis, of course, and understanding a company's fundamentals, as well as broader market trends.
Mm.
While risk is inherent, successful investors make calculated decisions based on knowledge, not not blind bets.
So it's more like a game of strategy than a roll of the dice. You need to do your homework, develop a plan, and make informed moves. What's another common myth that the podcast debunks?
That you need a huge amount of money to get started. This perception often keeps people from even considering investing, but it's simply not true.
The podcast even mentions starting with as little as 500. That's really encouraging for those who might feel intimidated, by that perceived financial barrier to entry.
Exactly. And with the rise of fractional investing, you can buy portions of shares. If you can't afford a full one.
Oh, right.
It's a great way to, dip your toes in the market without committing a large sum up front.
That makes the stock market much more accessible. So we've busted the gambling myth and the big money myth. What's the final misconception, the final one we need to tackle?
The all too common belief that the stock market is simply too risky. While it's true that the stock market carries inherent risk, it's essential to remember that risk can be managed effectively.
This is where a well-thought-out strategy comes in. What are some key ways to mitigate risk, as highlighted in the podcast?
Diversification is crucial. Don't put all your eggs in one basket, so to speak. Instead, spread your investments across different companies, industries, and asset classes. That way you reduce the impact of any single investment performing poorly.
So if one stock takes a dip, it won't sink your entire portfolio. What else can investors do to manage risk?
Thinking long-term is essential. Remember the Apple iPhone example we discussed earlier? The real power of compounding returns kicks in when you hold onto your investments for the long haul. You ride out those inevitable market fluctuations.
Makes sense. It's about focusing on the bigger picture, not getting caught up in that short-term market noise. Is there a final tip the podcast offers? For managing risk, I mean.
Staying informed. This is perhaps the most crucial element. Do your research, understand the companies you're investing in, and keep up with market trends and economic news, of course.
Knowledge really is power in the stock market. By combining diversification, a long-term perspective, and a commitment to staying informed, investors can navigate the inherent risks and position themselves for potential success.
That's right. It's about taking a thoughtful, strategic approach to investing, rather than viewing it as a gamble.
We've talked a lot about the benefits of investing in the stock market, but what about the other side of the coin? Are there any potential downsides or drawbacks that people should be aware of?
Of course, yeah. It's important to remember that no investment is without risk, and the stock market is no exception. While stocks have historically offered higher returns than other asset classes, they can also be more volatile.
So there's a chance you could lose money,
Yeah.
especially in the short term.
Yes, that's a possibility, which is why it's crucial to only invest money you can afford to lose and to have a long-term investment horizon. It's also why diversification is so important.
It's about spreading the risk, not putting all your hopes into one single stock or sector. What about the emotional aspect of investing? The podcast doesn't really touch on that, but it can be a significant factor, don't you think?
Absolutely. Fear and greed. They can be powerful drivers in the stock market, and they often lead to impulsive decisions. And those can hurt your returns. It's essential to have a clear investment plan and to stick to it, even when emotions are running high.
So having a disciplined approach and not letting fear or greed dictate your actions is crucial for long-term success in the stock market. What are some practical steps people can take to develop that discipline and avoid those emotional pitfalls?
One helpful approach is to set clear financial goals and invest with those goals in mind. When you have a specific purpose for your investments, it can help you stay focused and avoid getting caught up in market hype or panic.
That makes sense. It's about aligning your investments with your overall financial plan and long-term objectives. What are some other tips for maintaining discipline and managing those emotions in the stock market?
Don't constantly check your portfolio. Obsessing over daily price fluctuations can lead to anxiety and impulsive decisions. Instead, you should focus on the long-term performance of your investments.
So it's about tuning out the noise and sticking to your plan. What else can help investors stay grounded? Avoid emotional traps, I mean.
Educate yourself about behavioral finance. This field of study explores the psychological factors that influence investment decisions, helping you understand common biases and develop strategies to overcome them.
That's a great point. By understanding how our emotions can impact our investment choices, we can become more aware and make more rational decisions.
Exactly. It's about becoming a more mindful investor and informed, of course,
Yeah.
recognizing the role emotions play and taking steps to mitigate their negative influence.
It sounds like having a solid understanding of yourself, like your financial goals, risk tolerance, and your emotional tendencies, is just as important as understanding how the market actually works.
Absolutely. Investing is a personal journey.
Mhm.
And what works for one person, well, it might not work for another. There's no one-size-fits-all approach.
So there you have it, a deep dive into the stock market basics. Drawn from that, insightful podcast that you sent over, we've explored a lot, like fundamental concepts, potential benefits and drawbacks, the importance of, debunking those common myths, managing risk effectively.
Yeah, we also touched on the psychological aspects of investing, highlighting, the need for discipline, emotional awareness,
Yeah.
and a well-defined investment plan.
Yeah, it's been a comprehensive exploration, and hopefully you feel a bit more equipped to navigate this whole world of the stock market and to make informed decisions, ones that align with your financial goals, of course.
Remember, knowledge is your most valuable asset when it comes to investing, that is. The more you learn and understand, the better prepared you'll be to make, sound choices and potentially grow your wealth over time.
Now that we've laid the groundwork, the podcast ends with a thought-provoking question. What type of company or industry would you be most excited to invest in, and why?
It's a great question to consider as you embark on your investing journey. Ultimately, investing isn't just about the numbers and charts. It's about participating in the growth of companies and industries, of course, ones that resonate with you.
It's about aligning your investments with your values and your vision for the future. So keep learning, keep exploring, and keep diving deep into this world of investing.
And remember, if you ever want to take another deep dive into a topic that sparked your interest, we're always here to help you navigate the information and extract those valuable insights.
Until next time, happy investing.